program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello, welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we can expect for the week, but let's begin with what we saw on Friday. A strong session with European shares closing at a record high, boosted by cooler US inflation data. The CPI report supporting the case for further interest rate cuts, which also lifted all three major US stock indices to all-time closing highs on Friday, with upbeat corporate earnings adding to investor enthusiasm. The S&P 500 and Nasdaq recording their largest weekly percentage gains since August, while the Dow logged its best week since June. This week, earnings are due from 5 of the Mag 7, Meta, Microsoft, Alphabet, Amazon and Apple, all due to report. And on Friday, Alphabet gained after Anthropic expanded its deal to use as many as 1 million of Google's AI chips to train its Claude chatbot. Alphabet shares advancing. Coinbase, got a boost after JP Morgan upgraded the stock to overweight from neutral. Decker's outdoor forecast full year sales below Wall Street estimates, sending shares of the sneakers maker down substantially. Ford jumped after beating third quarter profit expectations, and General Dynamics also surpassing estimates, sending its shares higher. Alaska Air, it fell after the airline cut its annual forecast. Well, US consumer prices increased slightly less than expected in September, up 0.3%, as a 4.1% surge in the cost of petrol was partially offset by a sharp moderation in rents, keeping the Fed Reserve on track to cut interest rates again this week. In the 12 months through to September, inflation rose 3%, excluding the volatile food and energy components. Core CPI gained 0.2% for the month. And Chinese and US economic officials have come up with a framework for a trade deal ahead of the meeting between President Trump and President Xi later this week. US Treasury Secretary Scott Bessent said talks on the sidelines of the ASEAN summit in Kuala Lumpur had eliminated the threat of Trump's 100% tariffs on Chinese imports due to take effect next month. He said he also expects China to delay the implementation of its rare earth minerals and magnets licensing regime by a year while the policy is reconsidered. Well, US Treasury yields were little changed on Friday. The 10-year did turn lower after the CPI data, but finished up at 4%. The 2-year was around 3.48%. And the US dollar little changed. The Aussie, it's climbed back to 65.4 US cents. Oil prices were slightly weaker on Friday as doubts lingered about the Trump administration's commitment to sanction Russia's two biggest oil companies. Brent crude futures at $66 a barrel. Copper was up to be trading close to a record. Iron ore fell slightly to $104 a tonne. And gold paired losses, spot gold falling to $4,118 an ounce, but had lost 6% over the course of last week. And Bitcoin has risen to above $114,000. Let's get more on what we're seeing globally this week. Isaac Poole joining us from Ascalon Capital. Isaac, welcome back. Good to see you. Now, a big week ahead, particularly for the central banks, the Fed among them, of course. And that likelihood of a rate cut this week certainly firming off the back of that inflation data. Mind you, it remains elevated, but obviously rising less than expected.
That's right. The inflation numbers continue to point to some stickiness in inflation, and I think importantly suggesting that tariffs are a process that will need to work the way through the US economic system, but they're not sufficiently high to prevent the Fed from cutting this week. And realistically, the Fed has now switched away from inflation, which they've not been so far as to say it's transitory, but they are pointing to one-off impacts from inflation. They're really focused on the jobs market, and that is slowing, both according to the official data that we're no longer receiving, but also the private sector data that suggests there is a clear slowing trend in hiring and a clear slowing trend in demand. That is a risk enough for the Fed to cut this week, and most likely again in December.
Now, Isaac, I see you also point to the ongoing US government shutdown as a consideration for the Fed at the moment.
It is. I think that while markets have become very comfortable looking through it and saying that it's not such a major concern for them at the moment, I think the Fed will be less willing to do that. This is starting, we're moving towards a full month of shutdown that will be impacting consumer spending decisions. There are a number of government workers who will not be receiving pay over the course of this month. And that's going to have an impact, at least in the near term, in spending. So I think, again, that just points to the Fed erring on the side of caution, perhaps framing these as insurance rate cuts against the risk that the labour market slows further or that the government shutdown bleeds through to actual economic activity in the fourth quarter.
Now, Isaac, I did point to it is a big week on the central bank calendar. Of course, we've also got decisions from the Bank of Canada, the ECB, and the Bank of Japan. Interesting what's going on in Japan at the moment, of course, with the new Prime Minister, seen as a conservative there. Looks as though she's going to follow the Abenomics style of policy. What are you looking for there? And I guess particularly what's going on with the yen at the moment?
Yeah, I mean, this is a real challenge because the Bank of Japan has a history of delaying actions for a long enough period that the window closes on them to do effectively the right thing. And I think we're seeing that at the moment. Rates should have been hiked more than they have. Inflation is clearly sticky. The yen has been slowing or weakening against the USD for some time and looks like there are further downside pressures to that currency, which will only add to the inflationary challenge that the new government is facing. That all points towards the need for a rate hike, and it has been a real opportunity for the Bank of Japan to get rates back to something that looks normal and would move their country away from the financial repression they've been suffering for the last several decades. Unfortunately, it looks like they're going to delay that, and I think that we may see further delays to the point that the window will close and they simply won't be able to hike rates as global economy slows. So all of that just suggests there may be a bit more downside pressure on the yen. Of course, we may see some intervention and the Bank of Japan has been willing to do that. But right now, we're probably not at those levels where they intervene. So expect some more weakness as the Bank of Japan jawbones rather than taking actual active action.
Now, Isaac, staying in that part of the world, the other big event look forward to this week, towards the end of the week, is that meeting in South Korea between President Trump and President Xi. What can we expect there? Because there was a bit of news, certainly over the weekend, on the sidelines of the ASEAN summit in Kuala Lumpur. The Treasury Secretary, Scott Bessent, there pointing to the framework of a deal that is in place.
Yeah, and I think this is interesting because, of course, everyone had thought we had a framework for a deal and announced several months ago, and here, of course, we have another one. So I suspect that there may be some positive concessions from both sides when the two presidents meet, but ultimately this won't be an endpoint. We can expect rolling news over the next 12 months, perhaps, as both countries flex the leverages that they have. And on China's side, that's certainly rare earths, and in the US, that's chips. But this won't be the end of it. A framework may very well be suggested at, but I think markets have been both willing to look through a lot of the announcements we've heard recently and may ignore this one. But overall, I think it will just add to the noise and uncertainty that's surrounding the ongoing tariff framework that's been rolled out by the US.
Now, Isaac, also a big week corporate-wise in the US with earnings from 5 of the Mag 7. What are you going to be watching out for?
I think that once again, we've seen expectations worked low enough that the hurdle for beating is not so high, but the overall trajectory for earnings growth is slowing. And this is really important because it's been margin expansion that's been driving earnings growth. Without that, sales growth has been slowing, and that would otherwise point to quite weak earnings growth. So there's some risk or some positive risk that we get earnings beats, but I do think the market is starting to see through this a little bit, and the trend will be for earnings misses to be punished very significantly. And you've seen that over the last couple of weeks with some big moves on any guidance that's been weaker or results that have been weaker. And the flip side is, particularly this week with many of the Mag 5 reporting, I think that any beats will not be as positively rewarded. And that's important because it does set up a situation where markets really do need to see not just a beat in earnings, but a mega beat in earnings to justify the PE valuations that are stretched out there. So I think the initial reaction from markets will be, hey, this is positive, earnings are being beaten, but over the next few weeks, I think that may just come under question a little bit, and you'll see a bit more volatility across the sector.
And of course, that comes with that backdrop of ongoing concern about an AI bubble having formed on Wall Street, particularly the nature of those circular deals that have been done.
Exactly. There are some questions there, and you see that over the last couple of weeks where it's been a very volatile period for these companies. And investors are just trying to tease out how much of these deals are being funded by cash flow, how much will need to be funded by debt, whether there will be a material enough return on investment to justify the capex that's taken place, and of course, whether the earnings can continue not just to be elevated, but really re-accelerate. And I think once we start getting to these circular deals, the ability to re-accelerate earnings growth is just going to be harder. And none of this points to the fact that we need a correction or a large bear market. I just think it may be wise for investors to consider returns that may be somewhat lower than we've seen over the last 5 years and just prepare for that.
Isaac, great to get across what you're seeing globally. Thanks for joining us from Ascalon Capital.
Thanks, Andrew.
All right, let's check the local market where we're likely to start. Looking for a positive start there on this Monday. SPI futures up around 0.3%. That's obviously also off the back of a very positive session we saw on global equity markets on Friday. Number of quarterlies to get across today as well. We'll do all that in just a couple of minutes. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.